All right, guys, today we're going to be talking about Sofi yet again. Welcome back to the channel, guys. Corey here. Be sure to subscribe and tap the bell if you guys enjoy the content, and give me a thumbs up as it greatly helps the channel. I want to talk about one of my favorite stocks in the world right now, and that is Sofi. We've discussed this before, but today I want to get into things a little bit differently with earnings coming up, and I want to discuss why I believe Sofi could be headed to the $20 price point in the next 12 to 24 months. There's been people on my channel that have come by and said that Sofi is going to be stuck at $6 or $7 forever. I don't feel this is the case, as they've become profitable. It takes time for the profits that a company makes to translate into share price. You see, there is something else other than just profits or cash flow. When investors look at a company, they look at the company's EPS and PE ratio, price to earnings ratio, which compares the share price to the EPS. And I'm going to explain that to you a little bit more detail here in a second, so stick around. I'm going to explain that to you. Right now, they're struggling to have a positive EPS of 1 or even 2 cents a share. And because of that, that means the PE ratio is very high, which is not good. Ideal PE ratio is between 20 and 25. However, if Sofi could even get to 50 or 40, that would be great. 50 is going to be a heck of a stretch, considering their PE ratio right now is 800 plus. Let me explain to you guys how to calculate all that. We're going to talk about a few fundamentals and technicals, as well as some more financials on Sofi. Now, I just want to point out that I'm not a financial advisor, and this is not financial advice. I'm just giving you guys strategies, technicals, fundamentals, financials, explaining things to you, giving you guys the overall market sentiment, teaching you how to manage positions, but it's ultimately up to you to decide which stock you would like to spend your money on and how much of a position size you would like to have. So it's time to show you how to calculate EPS on a company of your choice. We're going to take net income, which is $47.91 million, and we got to subtract the dividend payments. You'll see Sofi has preferred dividends of $10.19 million, leaving them with $37.72 million. And then we got to divide that by the shares outstanding, which you can see here. Shares float 977.88 million. So we'll divide that by 977.88, pretty close to 4, but we'll just say 3. So the EPS is about 3. Now, they reported an EPS of 2. So I'm not exactly sure where that discrepancy is, somewhere, but just for average, their EPS by my calculation is 3. Maybe I'm missing a dividend payment somewhere. But see right here, basic earnings per share, 0.4. So I am right, 0.3804. Okay, so that is their EPS year-over-year growth. If we were to try to figure out how would they get a better EPS, with that 37.72 million, even if they were to only have 400 million shares outstanding, their EPS would only go to 9 cents. And that is not that good. And in order for them to get a better EPS, they're going to have to make more money. So let's say they made $150 million minus the dividends, which obviously the dividends would be more because they made more profit. However, we'll just leave it there for now. 139 million divided by 977.88 outstanding shares. The shares float, giving them an EPS of 14 cents. Much better. So realistically, if Sofi is to make it to $20, they need to at least have a PE ratio that values an increase in growth. With a EPS of 14 cents, this gives them a very specific price to earnings ratio. Let's calculate it. Price to earnings is the share price, which is 752, I believe, or 760. So share price of 760 divided by an EPS of 14 cents gives you a PE ratio of 54. That's pretty good. That's not great, but that's pretty good. With a PE ratio of 54, a forward-looking PE ratio of 54 would be pretty good. So that's a 54 PE ratio. And if we divide 760 by the current 02, their PE ratio is 380. I could see if the earnings report close to 100 million in profits and an EPS that's in line with, say, 8 to 10 cents, the stock price almost surely won't fall below $9 after that. We'll be well into $9. And PE ratio ratio is important. If we go over to their cash flow, 430 million is their trailing 12 month. If we look at quarter four, free cash flow, 178 million, 1.98 billion from financing activities, other financing sources that brought in $11 billion. Their investing activities, they had some capital expenditures, and they also purchased investments here. Their free cash flow, 178 million, and their cash from operating activities is 215 million. So they are profitable. They have good cash flow. They are growing and getting more and more profitable. The balance sheet, the income statement, the cash flow, everything looks good. The problem is the share price is not going up because their PE ratio is not that good. In fact, it's quite bad. However, if we look at SoFi's EPS previously at 21 cents in the negative, that was terrible. And this was only in October. And that got investors sour because they went from negative 6 cents to negative 21 cents. Now they're up to the positive 2. So if this earnings, I'm getting a little crazy here, but if they can at least get 4 to 6 cents EPS, the share price will go up, and it kind of goes in line. PE ratio, share price, EPS, they all work together to give a better understanding of a company. If the EPS comes back over 4, like say 4 or 5, stock price is most likely going to go to $8.50 or $9 and pretty much settle in there. New home, new bottom will be $8.50 to $9 roughly. If the EPS comes back 10 cents, 12 cents, 14 cents, it's likely will be closer to the 9.50 or 10, and it will stay there for the most part. In order for SoFi to get to $20 a share, we're going to have to see a PE ratio that's better. We're going to have to see EPS probably in the 20 cents. If we want to see $20, we need to see about a 20 cent EPS, roughly 15 to 20 cents. And in order to do that, they need to be profitable with at least 150 in net profits, maybe in 175. So if we're to see that, SoFi needs to generate about 150 to 200 million in net profits, and their cash flow, free cash flow, is going to have to be well into the 300 million. And what's going to happen is if they do that, people are going to start buying shares, which means the float or the free shares outstanding are going to go down. When that goes down and their profits go up, the EPS goes up and the PE ratio goes down. You follow? This is I know it's kind of confusing. So if their free cash flow goes up, their net income goes up, that means their EPS goes up and their PE ratio goes down. So more and more people start to buy the shares. So their share price goes up, which in turn makes the PE ratio go down even more. So that's how it works. They need to make more profits and they need less shares outstanding. So people need to buy the shares to drive the price up. And in order to do that, they have to make more profits. So they got to run a tight ship over there at SoFi and become even more profitable so the EPS goes up, enticing investors to buy up the free float. And by doing that, it basically means that the PE ratio goes down. And it's almost like a snowball effect. And that is how SoFi is going to do it. Mastering the art of trading and investing is very difficult. It's not an easy task. And I told myself that when I became profitable and was able to overcome all of the obstacles I went through, going through a major divorce and having 2 kids in the balance and a very long 5-year divorce, going through college, a pandemic at the same time, it was really a lot of work. But I was able to grow my portfolio and make a lot of money trading because of the fact of my consistency and my plan. And I told myself when I became profitable and was able to live a better life that I would share this with everyone else and try to teach the proper way to invest and the proper way to trade. Really want to see you guys succeed, which is why I'm going to be giving you guys the best strategies that are the safest and that are not super risky. And that's the reason why I trade the way I do, because it's consistent income. Okay, so let's go ahead and take a look at SoFi on the chart. You see, there's a lot of uncertainty in SoFi, kind of going up, down, up, down, up, down. You guys can see it's heavily traded between $6.80 and $8. Like basically $7 to $8 range is where it's been trading ever since the previous earnings. Let's go back and look at the previous earnings. This was pretty decent on January 29th. There was a big sell-off here. Everything with SoFi looked pretty decent until March 4th. This earnings could change everything. Now, I'm not trying to tell you what to do with your money, but if I was a betting man, they're going to beat the estimates. And if that happens, SoFi is probably going to come down a little bit. And then on Monday, we're going to look at something like this, and SoFi is going to end up here. My bet is that somewhere in May or June, probably end of May, beginning of June, we're going to end up somewhere up here. We're going to be well back into the 8.50 range, maybe even higher. If they report a 12-cent EPS, it's going to be like this. It's going to sit up somewhere up here. If they were to report a 12-cent EPS, that would be blowing the roof off the joint. That would be crushing it. Realistically, if they miss the EPS, SoFi is going to end up down here somewhere. If they beat the estimate, they're going to end up somewhere up here. And if they beat it immensely, like I'm talking about 8 to 10 cents or more on the EPS, they could very well end up there. I could be off. I could be a little bit wrong, but that's how I feel. In order to break the barrier of $9, we're going to need some really good news. Okay, guys, let me show you how you can get into SoFi for a discount. So if we look at the put option of $7, 93% volatility. If we look at next week, 116, that's because of earnings. And I don't think SoFi's going below $7, just not really in my scope in the future. So you could sell a put $26 because of the volatility. And if we look at Vega determines every percent increase in volatility is 0.0040. What that tells you is every 10% the volatility increases, Vega increases the price of the option by $4. So if this volatility goes to 130, then this option's now going to be worth $32. And as you get closer to next week, the volatility is going to increase. So that's really good. And right after earnings, you have something called IV crush. The implied volatility drops drastically and the option decays very quickly. SoFi's earnings are next week on Tuesday, the 23rd of April. And let's just say that this option is worth $21. Instead of having to wait for this option to decay until Friday, once earnings come out, if the price doesn't drop below, let's just say SoFi stayed at the exact same price. After earnings, the value of this contract would go down because the volatility would go down. So therefore, Vega would lower the price. If the volatility dropped to 50% right after earnings, this would basically be almost worthless. It would be like a 60, 70% reduction in the premium price. And that is called IV crush. So I recommend selling a put on SoFi for $7. That's what I would do. And with IV crush on Tuesday after earnings, this thing's just going to disintegrate on Tuesday and Wednesday unless SoFi goes below $7, which I don't see. The stock price has moved so far away from the put and the volatilities went down. It's just crushed it. It's worth nothing. That's what I recommend. I recommend selling a $7 put on SoFi. If you don't want to do that, you can just buy the shares outright and we go ahead and sell a covered call for next week. Again, implied volatility is up. Look, 113%. So we go ahead and we can sell, let's say, a $9 covered call. We could sell that for $12, collect $12 juicy premium. If SoFi goes to $9, then you can roll out and you can roll up for another credit of juicy premium. You do not have to stay in the call. If SoFi is right at $9, however, at $3.45, $3.50, SoFi drops to say $8.95 or 98 cents, you won't get assigned as long as the stock price is below $9 on expiration at 4 p.m. Friday the 3rd. However, you'll have a pretty good understanding of what's going on because after earnings and the spike of the stock price, it usually settles, comes back a little bit and settles for the rest of the week. So if SoFi settles in at $8.25 or $8.50, highly unlikely it would go to $9. You'll notice this way before expiration. Okay, so if you guys are wondering how do you roll a call or what happens if you get into a situation where you need to roll the call out and down or out and up, or you don't want to roll out at all, you just want to go up or down, let me show you exactly how you do that. If you're worrying about the stock price hitting the strike price of your covered call, let me show you exactly what you can do to fix that. So this is Roblox. I have a leap option on Roblox and I have a $35.50 covered call against it. However, it was $36.50. I rolled it. You will see here the roll, I got $18. I closed out the $36.50, same date. Roblox was going down in price, so I lowered my strike of the covered call and collected more premium. premium. The original position was filled for $47. Then I closed it for $10, reopened the new position for $28, which gave me $18 extra. So I made $65 this week on one covered call. And I'm probably going to add a significant portion to my portfolio of Roblox soon, but not yet. And I want to show you guys what you do. Look at Roblox. The price is $34.83. If I say, you know what, I think that in the next day I can scrape more juicy premium, I want to do this. There's no way Roblox is going to go above 35. I can roll down to 35 from 35.50, same expiration, and you will see that I will collect 21 more dollars juicy premium. If you feel like a stock is going down, you can keep rolling your strike down at the same date. So in the next 2 days, if Roblox doesn't go above 35, I collect 21 more dollars juicy premium. If I feel like Roblox is now going up, obviously we can't go up because if I go up, I have to spend $14. We don't want to spend money unless we think Roblox is going up drastically and our long position we want to sell, then we could take a $14 hit to make a couple of $100. However, we roll out to next week, and then we roll up from 35.50 to say 36 or even 36.50. If we go to 36.50, then we're still going to collect another juicy $10 premium. However, this is an advanced tip for you guys. I want to show you why you would not want to do this before expiration. The theta of next week's option is 0.510, which is $5 a day, okay? The option that we currently are sitting on is $16 a day. So I still have 2 days left to trade, Thursday and Friday. So if I just wait, let me show you what will happen. Instead of rolling this Thursday morning, I'll roll it at the end of the day on Friday. What happens here is we have $16 minus $5.50 is $10.50. $10.50 is how much more this option will decay in comparison to next week's option. Times 2 days means we will gain $21 from time decay. So instead of collecting $10 now or Thursday morning, we could wait until 5 minutes before expiration on Friday, and I would collect 21 plus 10, which is $31. That's how you utilize time decay for profits. So essentially, I will roll this out to next Friday for $36.50, going up $1 and out a week, and I will collect about 31 more dollars. So you can see how easy it is to roll covered calls. You can roll down multiple times or up multiple times in the same week. You can roll out and up, out and down, or just up and down the same week, which I do all the time. I want to do a video on it, but I want you guys to let me know in the comments below if you want me to make a video just for you on how you can roll for profits to continually make money over and over again, no matter where the stock is going. You're basically just rolling up and down for a consistent profit with low risk. If you guys want to see that video, leave your comment below. I believe in Sofi. I really do, but there's some ground to cover for Sofi. They need to report a better EPS this earnings call. If they can report 3, 4, or even 5 or 6 cents, we're in good shape. If they can continue to do that throughout the rest of the year and get ourselves to an upward momentum where we're going from 3 to 6 to 9 or 10, and we can get closer to the 10 or 12 cents on the EPS, we could see stock prices get to $12 to $15 by the end of the year, maybe a little higher. And if the first and second quarter of 2025 are just as good or even better, we could start to see Sofi trek into the mid to high teens. $20 is very possible, but not only possible, it's very probable because of the already illustrated financial growth and profitability of Sofi. So it's not a matter of will Sofi reach $20, but it's more of a question of when they will reach $20 a share. Hope you guys enjoyed this video. Thank you so much for stopping in. Be sure to subscribe and tap the bell so you know when I post new videos. And if you can, give me a thumbs up as it greatly helps the channel grow. But remember, until the next video, take care of yourselves and let's grow our wealth together. Take care, guys.